Hello and welcome everyone to the Founders First Capital Partners Fireside Chat Leadership Series. This is our third annual iteration of the Rock Stars of Revenue-Based Financing with a great panel of revenue-based financing rock stars to present to you today. Before we begin, I want to just do a little housekeeping and let you know the Q&A box is open. Feel free to post any questions within there. We've received a really good amount of questions ahead of time through the registration page. So we'll be addressing those first. If we have any time left, we'll get to any questions that you put in during today's webinar. And with that, I will introduce our two moderators. We have Casey Estrada and Brandy Lipton from Founders First Capital Partners. Casey and Brandy, feel free to introduce yourselves and share a little about your background.
Thanks, Tracy. Yeah, hi everybody. Thank you for joining us today. I'll be moderating here with my colleague, Brandy Lipton. We're both more on the business development side here at Founders First. Of course, working to find all types of companies that are looking for funding. I've been with the company now just about 2 years, but I've been in the revenue-based financing space for, gosh, going on 6 now. Brandy, I'll turn it over to you.
Hi, everyone. Nice to meet you. Brandy Lipton. I've been with Founders First for just about a quarter now, but I've been in the alternative lending space serving entrepreneurs for 6 years. So really excited to connect with you all.
Great, thank you. Well, welcome to everybody in attendance. Here's just a little rundown for what we'll be going over today. It should be a very unique and enlightening conversation. And I'm certainly excited to be here with Brandy to moderate the larger discussion about revenue-based financing today. And we really do have a who's who joining us on our panel. Like Tracy said, we are quite the rock stars of revenue-based financing. So next slide. Just to introduce everybody on our panel today, so we've got Kim Folsom, founder, chair, and CEO of Founders First Capital Partners, Keith Harrington, co-founder and chief operating officer of Novel Capital, BJ Lackland, chief investment officer of IBI Spikes Fund, and previously CEO of Lighter Capital, and Alan Tier, co-founder and managing partner of RevUp Capital.
What is revenue-based financing? RBF is growth capital that is usually leveraged either instead of raising equity or in combination with equity or in between equity raises. The amount of capital extended is based on revenue without looking at other assets in the business, and repayment is based on a percentage of monthly revenue. So it's really helpful for companies with seasonality, companies which receive payments in lump sums, companies which experience ebbs and flows in when they get paid, and really any company that has consistent recurring revenue. And revenue-based financing can be either completely non-dilutive or in combination with warrants, which we'll get into a little bit later. So RBF is one of the alternatives for early stage companies to leverage. Here on this slide are listed several other ways in which to access capital. Banks, which require capital, and the cost of funding from banks is usually low cost, but it's usually not enough for early stage companies. Fintech merchants, really easy, quick access to capital, but usually exceedingly expensive. Revenue-based funding, which is quicker to access than banks and relatively non-dilutive and relatively cost-effective. Angel investing, which is really helpful, but anytime you raise equity, it's very time-consuming. And then there's inventory financing for CBG companies, which again requires collateral to have access to. And then lastly, VCs, which it's great to raise equity, but again, super time consuming. You have to give away a large part of your business. So everyone has pros and cons, and we are here to discuss all the benefits of leveraging revenue-based financing today. Next slide, Tracy. Thanks.
Yeah, I'll go over some of the benefits. We can click over to the next slide. But I do like that slide Brandy was just showing, really the spectrum of where revenue-based financing fits. So it really does fill a void. There's this need in the market for capital that kind of sits between, you know, your classic debt providers and your typical equity investors. So for those of you new to revenue-based financing, the benefits highlight a combination of some of the best features of both equity and debt. So this form of alternative debt really takes its name from two factors. Brandy already touched on a couple of these, but really one is the monthly payment, which scales with revenue. And then so in bigger months, obviously the payment scales up, leaner months, the payment scales down. Idea being that debt service is predictable to cash flow. And two, the amount a business can qualify for is based on total revenue. So business will gain access to additional capital as they grow. Investors or financing providers in the revenue-based space, they're writing larger check sizes. This is growth capital, right? So like equity capital, funds are used to scale the business. Think key hires, sales and marketing initiatives, product development. And revenue-based facilities offer longer and more favorable repayment terms compared to other debt options available. We'll get into this later, but revenue-based financing is not a working capital solution, specifically like factoring or merchant cash advance. This list here highlights some of the most common benefits of revenue-based financing. Run through them real quick. Limited financial covenants. This is certainly less restrictive than a lot of bank debt these companies can qualify for. No loss of control. You're not giving up a board seat or really any influence. It is just a loan. No requirement to collateralize personal assets. You're not making a bet on the success of your business with your house, and mutually aligned interests. So, you know, the loan is repaid as a percentage of revenue and is typically modeled on projected growth. So essentially everybody wins when the business grows. And of course, founders are retaining value upon exit because revenue-based financing is typically non-dilutive, but certainly less dilutive than equity. A couple of our panelists might get into this a little more on the specifics, but typically any equity component is just future upside and not upfront dilution. And click over, next slide. This kind of just gives an overview of where revenue-based financing sits here in the grand scheme of things. And then if we can keep going here, just to walk through a structure of a revenue-based financing loan. So, you know, this is a pretty wide range, and, you know, depending on the provider, you know, terms could vary, but a very typical example here would be, you know, a business has an annual revenue of $1 million, and a revenue-based lender might qualify that business for 20% of the revenue. So in this case, you know, $200,000. And the total obligation is referred to as a repayment cap. So in this case, a 1.3x return. So that's the $200,000 in principal repaid back over the 3-year term with $60,000 in interest. And based on the projected growth determined through underwriting, a fixed monthly royalty of 5% of revenue, or more specifically, net cash receipts, is taken as payment. Of course, the structure is determined by a number of factors. So for example, the repayment cap is typically smaller for a shorter term loan. Royalty rate would scale up or down depending on how much the business takes versus how much they qualify for. But again, the idea here is that this is flexible. It fits in with the growth plans of a business, you know, and they're not locked into necessarily any certain terms. Next up, really like to go through some of the use cases, and I'll turn this over to Brandy.
So again, this continues with the benefits that Casey was highlighting. So firstly, leveraging revenue-based financing enables you to improve valuation ahead of an equity round, because you can invest in sales, marketing, go-to-market initiatives. And by doing so, you're going to look more attractive to potential investors. You're also able to retain more control. As mentioned, dilution is either no dilution or minimal dilution. You're enabled to leverage revenue-based financing to launch new products without having to take resources away from the rest of your business. Another benefit is you're enabled to expand into new customer segments, and the flexible payments are tied to monthly revenue, so there's no risk of expansion and then having to pay off the loan immediately. And then number 5, exit strategy. Revenue-based financing can be part of your exit strategy because it enables you to extend your runway, and thereby when you do exit, the investors are coming in at a higher valuation. And lastly, acquisitions. When you do have an acquisition or you're part of an acquisition, revenue-based financing can be leveraged to help sales once the acquisition takes place. Casey?
Thanks, Brandy. And to reintroduce and include our panel for this next segment, panel guests, I'll introduce you one at a time and ask you to provide some background about yourself, more information on your firm, and what your typical customer profile looks like. You've each brought a case study with you as well, which we would like to highlight. So first up, Keith Harrington, Novel Growth Capital.
Hey, everybody. I'm Keith. I am co-founder and COO of Novel Capital. We are based in Kansas City. A little bit about me. So before starting my journey in revenue-based financing, I was actually a VC, and I was an operator in startups before that. Most recently, before co-founding Novel, I was a co-founding GP in an ag tech fund, and I spent so much time saying no to entrepreneurs that I just got frustrated. So I ended up kind of shrugging my shoulders so frequently that I said, there's just got to be a better way. There's got to be a way to fund more entrepreneurs more broadly, more frequently, excuse me, and help them grow their businesses. So I started poking around at different models, trying to figure out what might be a better way to help entrepreneurs grow, and landed on the idea of revenue-based financing, and have built Novel since then. So as I said, we are based in Kansas City. We are averaging a check size of about $500,000. I think it's like 470K at this point. Typically, we see our capital being used to, I think, as has been shared, mostly for growth capital, sales and marketing, business expansion. Those kinds of use cases are really great for the kinds of money that we provide. We do have different repayment lengths or maturities depending on the kind of deal that a company is looking for. And we do have the opportunity or the ability, we provide the ability for companies to take only what they need rather than taking a lump sum. They can certainly take as much money as they like right out of the gate, but we also provide sort of a line of credit functionality that makes it a little bit easier to consume exactly what you need when you need it. And then I think one of the most interesting things that we do is we're automatically underwriting in the background a company every month so that as a company grows, we can provide more capital or more access to capital as that growth takes place. We've done about 100. We've funded about 100 companies. Most of the companies that we work with come back for more money. So I think across those 100 companies, we've done 130 probably individual transactions, which we really like. We like it when our customers want more money. That makes us really happy. Typically what we're looking for is a B2B SaaS or a technology company. We do also provide funding to tech-enabled services companies. Minimum of 350K in annual revenue. We'd like to see growth of at least 10%. And typically we are looking to write checks of between 100K and $5 million. Anything that I've forgotten in there that I should talk about? No. Okay. That's my cue to just keep going. So a quick case study. So this is a company that we funded a couple of years ago. It's an ed tech business. Um, yep. Okay. Just make sure I'm looking at the right case study. So this is an ed tech business. Ended up providing to them $750,000 over the course of 9 months. Their major challenge was they had a business and it was growing. Obviously, it's growing at 50% year over year, but they didn't really have a solid go-to-market strategy. And in fact, they didn't really have somebody on staff who could develop one. They were all just sort of like, hey, we're kind of the founding team. We're growing this business like crazy, but we know at some point, like our ideas are going to run out and we need to have a systematic way to grow the business. So they hired a VP of sales, a director, I think, of growth, an AE, and a couple of other positions with the capital that we provided them. They hit $3 million in sales, as you can see here. They're growing at 75% after that year over year. And then about a year after, I guess it was 18 months after we provided capital to this company, they took on a pretty significant private equity investment of 40 million bucks. And they're off into the races. I think now they're growing at a little bit better than 100% year over year. So, of course, individual results may vary, but this was a great opportunity. This company easily could have gone out and raised equity. They had all the metrics. It was before the market sort of dried up, so money was a little bit easier to raise. But they were really interested in trying to make sure that they had enough growth to really maximize their future valuation. And so they just wanted to make sure they didn't take a bunch of dilution along the way. So great opportunity for us to provide a little bit of capital. We structured it so that they had access to the money over the course of a year. They just kept taking it down as they needed it. And it worked for them.
Thanks, Keith. Next, we got BJ Lackland, currently of the IBI Spikes Fund, and formerly my boss during our time at Lighter Capital together. Take it away, BJ.
True. Yes, my name is BJ Lackland, and as Casey mentioned, I'm currently the founder and chief investment officer of the IBI Spikes Fund. We focus on providing capital to tech companies based out of Israel. We are just hitting about 2 years since our first deal was funded. We've done about 35 deals, total of about $35 million now. Our average check size past year and a half after we kind of like found our sea legs and got going is about $2.5–3 million. And like I said, we focus on companies that are based in Israel, but we're starting to venture outside of Israel. Israel's a really great market for developing technology and helping companies come over to the US, but obviously it's a limited market with only about 10 million people. Before founding the IBI Spikes Fund, I was CEO of Lighter Capital for about 8 years. And during my time there, we grew from doing virtually no deals to doing over 150 deals a year. During my entire time, we did about 650 rounds of funding for about 350 companies. Those are generally smaller deals. Our average deal size when I left Lighter was about what Keith's was, what he mentioned for Novel. It was about $450,000 when I left. After having started, when I started, it was about $100,000. So we grew the deal size quite a bit over time, but mostly grew a lot of volume. Getting back to the IBI Spikes Fund, though, we are currently focused, like I said, on tech companies that are mostly in Israel. However, we are in the midst of launching a US-based origination platform that will be drawing capital from some of the same sources and really targeting a lot of the same kind of businesses. So tech companies typically with anywhere from like 3 to 50 million in revenue, doesn't matter if they have a VC sponsor or not, but companies that have an interesting and sticky revenue stream and that we can provide anywhere from like 1 to 5 million in capital for. We do revenue-based financing. We also do sort of standard term loans. All right, we go to the next slide. An example of a deal that we've done at the Spikes Fund is an ad tech company. This company was actually headquartered in the US, but it had a lot of the technology development in Israel. And so we saw that there was enough nexus in Israel to be able to fund it. It was a $3.5 million deal we did for a company that had kind of a unique situation. And a lot of times A lot of companies that take revenue-based financing will have kind of a unique situation. Like some of the people already mentioned, they're between rounds, they're doing all kinds of things. Well, this company had raised over 20 million in equity years ago, better part of a decade ago, had built a business up to 60 million in revenue. And then that major line of business started decaying and dying. And that major line of business now went from 60 million to now down to less than 2 million in revenue. In the meantime, the management team was super resourceful and figured out a whole brand new offering that frankly is a lot more valuable and durable. And they'd grown that up organically to about 12 million in revenue. So this company went up hugely in revenue, had one revenue stream die, management figured out a whole new revenue stream. But going and raising equity money into a situation like that with a bunch of equity sponsors that had been in the deal for a long time is really difficult. The company really wanted money to go out and grow and push heavy on the gas pedal so that they could really build the value of the company before then probably looking for an exit so I could get some liquidity for the investors and for the founders. They've done that. They've built the company up great. It's now well over 25 million in revenue. Used the money we provided in a very smart fashion, and are now sort of looking at their various options. The company's now growing 100% year over year, and we have revenue-based financing in it as well as a warrant. We get warrants in our deals about 3/4 of the time, but they're large enough deals, so we figure it's drives a little bit more alignment than just pure RBF, as well as it is something that you can do on a larger deal, I think, much more easily than we could do in smaller deals. When I was at Lighter Capital, we never really took warrants on deals because it's really difficult to go and add that whole negotiation in when you're trying to do, 130, 150, 180 deals a year. It's just too much. But we like the warrant at the Spikes Fund to be added in there, just thinking that it drives extra alignment towards the upside.
Next, Alan Tier, Rev Up Capital.
Hey. Thanks, everyone. It's always good to be, third in the lineup because you get to just play off of what, great investors like Keith and BJ have already said. I learned a lot from the work that BJ did at Lighter when we were starting Rev Up. We built the fund in 2015 and launched in 2016, and that was after 6 years of running an equity fund. And we arrived at the idea of Rev Up really as an alternative to the unicorn or bust myth that kind of is the one-size-fits-all narrative that we seem to still put onto companies in their earliest stages. And I definitely participated in that in my role as an equity investor. But after 6 years of it, my partner Melissa and I really tired of the one-size-fits-all model. We wanted a way, as Keith said, to invest into more founders and find more win-win opportunities for both the founders and the investors, and an opportunity for them really to choose their own adventure. So we launched Rev Up in 2016. Our targets in terms of deal size our checks right now are between $400,000 and $500,000 a deal, generally looking for companies that are approaching $1 million. And we kind of have built our team as specialists on the $1 to $10 million journey. So our observation is that it's one thing getting to $1 million. It's one set of skills. It's almost all founder-led hustle. And the transition from 1 to 10 is quite a different journey. It requires a different set of skills. It requires rebuilding the internal components of the company as well as the market-facing growth engines. And that's where we've positioned Rev Up. So in addition to our investment into revenue growth, we also have an internal growth platform that becomes an extension of our companies for 12 months after we make the investment. This is really intensive work that we do with the companies to help them to add more cylinders to their growth engine. It's turned out to be very effective at helping them grow to the next level. Generally, we are one-shot funders, so we don't have kind of continuous capital approach. A lot of times that companies, if we've done our job correctly, will be able to access cheaper capital further down the market or further up the market as they grow. But we're really pleased with the progress our portfolio of 50 companies has made overall. Just want to go to the next slide, and I'll give you an example. So one thing that we do invest in is I think we find our portfolio goes a little wider than some of the other revenue-based investors. We do have a fair number of SaaS or SaaS-y companies, as well as tech-enabled services, but we funded quite a bit of ed tech, distribution, training, and a little bit of hardware and e-commerce and consumer services. Many of those investments have worked out well for us. So we really look for revenue patterns and growth levers that we can help the company to pull. Tizuta is a good example of that. Relatively recent investment of ours, made within the past year or so. It's led by Jesse Garcia, who's an incredible engineer out of Temple, and she had a personal experience with traumatic brain injury that caused her to start a company to really ask the question, how can we know if somebody, a athlete or a worker, has had a head injury that might expose them to a concussion. And she, through many iterations and a lot of hustle in terms of resources, created an incredible product that's a mechanized impact indicator rather than a high-tech, Internet of Things electronic indicator. And the beauty of these little indicators is they can be put onto the back of really any helmet, motorsports, football, construction helmet, etc. And they provide a very obvious indication as to whether the user has sustained a head injury. And this is drawn for when we found them. They really had traction in a few places, both in motorsports and some public safety environments, and a smattering of football teams ordering these things. But they really wanted assistance in taking the product to scale, in figuring out the kind of internal and external transformations that it was going to take to build this into $10 to $20 million business, and to play with much larger players in the market. So they've used our money to hire, to build out the market-facing team, to start to mature some of those different individualized niche markets that are going to help drive their growth.
Thank you, Alan. And then last but certainly not least, Kim Polso.
Well, thank you so much. I'm so honored to be joining this panel with such esteemed experts that have really been leaders in the whole alternative and revenue-based financing, especially like Alan and Keith mentioned that BJ's leadership in demonstrating how viable this alternative funding methodology has been just tremendous. And I have goosebumps to be doing this again for the third time as we launch this webinar. So I'm the founder, chairperson, and CEO of Founders First Capital Partners. And I came into this work from being on the other side of the table as a technology-based founder of 6 venture-backed companies. Saw that there should be some more equitable way of growing and funding companies. And then to mention what Alan brought up is that, there needs to be alternatives than just you're going to grow to be a unicorn. So it was that view that we launched Founders First platform, from the standpoint of there's a rise in diverse business owners that have launched businesses, and the more that you can take the time in leveraging non-dilutive capital to grow and scale your business, as was brought up earlier, that you can have much more control as far as the the dilution of the growing of the business. I mean, we look at revenue-based financing should be complementing the capital stack. So it's not, one or the other, but it's both, and being able to leverage this is a great tool. So at Founders First, we're addressing the gap in capital for diverse-led businesses, and we have a pretty broad definition of diverse-led businesses that includes businesses led by women, people of color, military veterans, LGBTQ, and those in low and moderate income areas. We are a national platform. Generally, our businesses are generating between $500,000 to $10 million in revenues, and they're profitable. Our typical deal size is $300K. And in addition to providing capital, we also provide post-funding advisory support and helping companies with, strengthening their business model. Our affiliate organization we have a growth-focused accelerator and providing kind of pre-funding education. Typically, the companies we fund are tech-enabled and B2B service-based businesses. Our companies are generally suppliers to corporations and government agencies. The ideal company is generating $1 million and up, and they've been in business for at least 18 months. Next slide, please. So this is an example of one of the companies that we funded, and this is like what you heard from some of the other companies. We not only provide the initial source of capital, we also can provide follow-on capital to them. And we can do that and follow-on capital up to $2 million. This particular company, Quality Interactions, this, like some of the other examples you heard, was an ed tech company. Their specific focus was in providing continuing education and cultural competency to medical professionals, and to help them with understanding about how to properly treat the health disparity of a diverse patient base. When Quality Interactions came to us in 2018, they largely were servicing educational hospitals, university hospitals, and a few insurance companies, but they saw that there could be broader appeal for the type of ed tech platform and medical continuing certification. So with our dollars, they were able to expand their team as well as expand their product offering and market segments. Such that the company grew over 300% from when they started. And even despite COVID, they were able to expand and grow into additional market segments. And ultimately, they were able to get onto the 2022's Inc. 5000 class. And as part of our work with Quality Interactions, we actually did an initial funding of them in 2018, and then did a follow-on funding with them of in 2020. And back to you, Casey.
Thank you, Kim. Yeah, well, so like Tracy mentioned at the top of the webinar here, we did open up forum for questions during the registration process. We do have a number of questions. We'll kind of go back and forth here. Brandy, I think you've got the first one.
Yeah, so question for the panel, what advice would you give companies who want to leverage revenue-based financing and alternative capital for growth in this very difficult current financial market?
I'll spitball on that one. What was the question? What advice would we give? Well, I think it is a difficult fundraising market. The good thing about revenue-based financing, and whatever flavor you go explore it, is I think it's pretty clear what kind of metrics you need to hit. You don't have to sort of do the dance with VCs or angels who kind of move the hurdles, so to speak. So, you know, I think if your business has solid fundamentals and you can legitimately plot a path to profitability or sustainability, then RBF is a real option. If, on the other hand, your business is in a high burn mode, then the advice I would give is to ratchet down the burn and make sure that you have runway sufficient to get yourself to sustainability. And once your burn is ratcheted down to some manageable amount, and I think different investors on the call will have a different point of view on that, then you can go out and try to raise an amount of RBF that'll help you continue to grow. But it really is, at the end of the day, the beauty of this structure and this approach to funding is it is about the business fundamentals. It isn't about some inflated TAM and ability to achieve $1 billion outcome. It's, if your business is fundamentally sound, then RBF can work for you.
Thank you, Keith.
Yeah, like I said, go
Okay,
ahead.
please.
I say,
Please,
go ahead.
please, BJ.
The only things I'd add to that is just to investigate a lot of options and really do the math. I think there's a lot of financing options out there that are sold to sound very inexpensive, like merchant cash advance, but are actually very expensive once you get into it. So I would be particularly skeptical of anything that's relatively short term. Like all the providers of capital here are looking at longer term, being with these companies for a long period of time. So they sort of almost by structure have to provide healthy capital because they need to be able to have a healthy company to repay them. But a lot of the shorter term capital sources, merchant cash advance, things like that, that by the way, don't call themselves merchant cash advance, can provide capital that unfortunately kind of puts you on a treadmill and you need to continually raise more and more and more just to pay off the first capital. So I would say make sure you really do the math very carefully, learn how to use the basic like IRR or XIRR functions in Excel. I mean, not to get too far down a rabbit hole, but you really want to make sure you understand what you're signing up for. And although financing has gotten tighter out there with interest rates going up, there is still a whole bunch of pernicious capital out there that is really harmful for companies. So just do the math.
Great pieces of advice to follow. I would add that, the great part of revenue-based financing with regards to the fundamentals that Keith mentioned are really great tenets with regards to, allowing you to get access to capital based on, think of it, your performance. And as you perform well, you are able to get, patient, non-dilutive capital that can help you with achieving your growth. And, there's the other point to what BJ mentioned, there's no such thing as a free lunch. If something is too fast and it seems too inexpensive, it is not a good thing. It is not a good thing. And it takes time to go through and do that. And so, as you look at your overall expenses, you may need to go through and really think through, adjustments so that you have a discernible path to profitability, as well as if you're not profitable, and then if you are, what things you can do to improve the unit economics and gross margin of your business. So there are, great capital sources out there, but you really need to be able to demonstrate and focus on those important performance fundamentals.
I might add one thing to what you just said, Kim, and kind of getting a little bit more specific on what BJ said. I think BJ said do the math. The math that I would really recommend entrepreneurs and CEOs out there do, aside from how much is the capital costing, two things that I think are really important. One, can you afford the monthly payment? Which seems like a really simple and obvious thing. But if you take a short-term loan, then often what happens is the monthly payment is so large that it becomes extractive, meaning it's taking out more money than you ever have a chance to than the value that you ever have a chance to create, because those payments are just so big. And at Novel, we see, I don't know, 2 companies probably a week that took a really large short-term loan and they're looking for a way to refinance that out. And those are, once you take one of those, it's hard to get rid of them. And so that's what I would really recommend you pay attention to. The second part of that is the term of the loan, which I think BJ also mentioned. But if you're not like 2 years long or 3 years long, then it could be too short a time frame within which for you to actually pay it back. So I would just urge a lot of caution, because as Kim said, if it comes at you fast, the way some of these term sheets do now, like we'll give you terms in 24 hours. That's not necessarily a good thing. And it feels great because they're offering you money. But again, we've seen over and over again CEOs who didn't need to make a decision in 24 hours, but they did because they had terms in their hands and it just turned out not to be a great deal for them. So I would urge caution, because at the end of the day, this is debt. So you need to think it through before you make a final decision.
Thank you all.
That actually that kind of covers my next question here, because I think we can all agree we've all been in revenue-based financing for a while now. It used to be revenue-based financing was really one structure, and because of you all, we branched it out a little bit. And there's these different offerings, all really still revenue-based, but we're starting to see, again, you all touched on this already, but these other types of lenders, short-term lenders, merchant cash advance type lenders who are putting offers out there under the umbrella of revenue-based financing. So I think all good points here, but any other advice that you can give companies as they kind of work through the market and try to really evaluate what's truly revenue-based financing as opposed to like a merchant cash advance, for example.
I think the length and maturity is one of the biggest factors that separates it. I mean, the fundamental sort of mechanics of merchant cash advance and revenue-based financing are somewhat similar, right? Merchant cash advance a lot of times is taking a percentage of the daily, usually, or weekly merchant receipts, and they're taking it until they get a multiple. Well, revenue-based financing is in some ways conceptually very similar to that. It's just all extremely elongated, where typically revenue-based financing providers getting paid monthly, and they're getting a relatively smaller percentage, usually of the revenue than a merchant cash advance provider will get, and they're expecting to get paid over many months or years. So I think that really the biggest difference is, if you're wondering if something is merchant cash advance versus revenue-based financing, is the term. Like I think Keith mentioned 2 years, and I think that's probably a pretty good mark. Most MCA is 12 months or less, whereas most revenue-based financing funds that are truly trying to provide growth capital are definitely at like 2 years or more. And so I think that's the great dividing line. I think this actually dovetails fairly well with one of the questions that someone submitted, is what's the advantage of RBF over factoring? It seems like that's a question that RBF providers get a lot. And so let me just take that one on. So factoring, for those that don't know it, is when you have a receivable. Let's say you go and you provide a bunch of services to some business buyer, and you then give them an invoice, and they're going to pay you in 45 days or 60 days or 90 days. Right. Well, you might be able to take that invoice and go sell it to a factor, and that factor will give you maybe 80 cents on the dollar for the invoice. And then maybe when you collect the rest of the money and they get paid off and how that, they'll give you a little bit more than that. Well, factoring has a couple pros and cons to it. Factoring is typically very short term, right? Because you're only basically getting an advance on the money for that shorter period of time. So it's really more of a working capital solution. It's something that helps you get past those difficulties of having outstanding receivables there for a long time, which you as an entrepreneur, let's say you're paying your employees today, but you're not getting paid by your customers until tomorrow, or 60 tomorrows from today. That can provide a huge strain on a business, and factoring can help with that kind of a transition or that kind of a need. Revenue-based financing can do somewhat the same. You can use it for working capital in some ways, but it's really more intended to finance something that's longer term, a longer term investment, right? Something you're gonna be getting a return on over a longer period of time. So think, instead of financing a receivable and getting that money out, think instead of investing in a salesperson or investing in a marketing initiative, or as Alan, his firm offers, like investing in a whole bunch of growth initiatives, right? That they're going to go through and do, so that it's not about, can I get my payroll paid, next month or next week? It's more about, can I be 3 times the size my business is today, 2 years from now, 3 years from now, 4 years from now? So that's really the difference between revenue-based financing and factoring. Again, it's a bit more of a time-based thing, where you're looking for a short-term solution versus a longer-term solution.
Thank you, BJ. Another question that came in: does obtaining revenue-based financing prevent you from accessing venture capital or traditional debt?
I'll start with this, and then allow folks to add to it. So as you heard us mention, the capital continuum or capital stack, that revenue-based financing is one component of that. It does not preclude you from being able to get access to venture capital. It is a hybrid between debt and equity, but on the the debt side, you're not having to take a value of get a value of your company to get access to the capital. You're not having to sell your equity to do that. However, you can most definitely take revenue-based financing after you've taken equity. We've funded companies in that situation, or those that may initially taken revenue-based financing and then took equity after, once they have solidified the revenue growth or product market fit, or added additional product offerings, such that they are a much stronger, bigger company, which ends up having an impact and improving their valuation. So it can be complementary if you choose to go that route.
Thank you, Kim.
I'll weigh
Yeah.
in here as well. I'm sorry.
Go ahead, Alan.
I think we probably, when we started the fund, we heard a lot of people who were concerned about more of a perception question than a mechanical question as to whether taking on RBF precluded venture capital or equity investment. And from our perspective, we've seen the comfort of equity investors increase dramatically with the idea of having RBF as part of the capital stack, both if they're already investors and realize the value of having RBF, to support a growth goal or provide non-dilutive financing or carry a company further on the money that they have, as well as a respect for it if the equity comes in after the RBF, where the investors understand the role of RBF in supporting the company and getting it to the point where it was ready for its next equity investment. So I think perceptions have softened a lot around that. We still do sometimes run into deals where the end conclusion of the existing investors is that they would rather that the company take more of their money, of their equity money, and not take the RBF. But that's a little bit agenda driven, right? Like if the equity investors decide that that's what they want, and if the entrepreneur decides that they want to give away that long-term value, which usually is worth a lot more than what you're going to pay to the RBF provider, then that's the judgment that the founder has to make, right? It's their business. But I think that the perception that we used to argue about from on stage with VCs 5 years ago of is it this or that has more or less gone away, and is not a real blocker in getting and having a diverse capital stack.
Yeah, I totally agree. I think it used to be like a perceived, exactly as you put it, Alan, as like a negative indicator somehow. And I think that a lot of VCs have realized that, entrepreneurs value their equity. And so being smart about it and, going and figuring out other ways to grow and make progress without having to go and do a whole bunch of equity rounds. So I think it has become far more acceptable. In fact, you hear entrepreneurs now sort of planning out their financing, and they'll be like, and this is when I do my RBF round. It's something that's like RBF round has become a thing almost. I think the other thing that's happened is a lot of VCs have looked across their portfolios. A lot of the leading VCs that do a lot of investing have looked at their portfolios and realized that a lot of really wise entrepreneurs that they funded have taken RBF before they funded them. When I was at Lighter Capital, we had two of the largest growth equity funds approach us because they'd done a review of their portfolio and realized that we were the most common provider of capital before them. And they were like in shock, right? They were expecting it to be some seed, investor or Series A or whatever it was. And they were like really surprised. And so it went from being this, thing that they would kind of, RBF went from this thing they would kind of poo-poo to suddenly being this, source of good leads for quality entrepreneurs that were accustomed to building their businesses in an intelligent way. So I would totally agree with what Alan said.
I just want to touch on the other half of that question, which is, does RBF prevent you from taking traditional or institutional debt? I would say that if for companies that are in that situation, it happens on a case-by-case basis, but certainly any RBF provider, tends to, guard their position on the capital stack and their obligations, the company's obligations to them and their obligations to their investors, fairly judiciously. And so the question as to how you mix multiple forms of balance sheet funding or balance sheet financing is really one that gets evaluated, based on whatever the situation is, what the need is, and who the players are at the table. It's not a real clear-cut answer, but it's not, it's not a simple one to answer. It kind of depends upon the situation.
Super helpful. Thank you. Casey,
Keith,
did you
I think I saw Keith come off mute. I don't know if you had a point you wanted to add, or maybe that got covered already.
Yeah, thank you. I almost forgot. The only thing that I would say is just a really simple answer to the question of, does it make it more difficult for you to take venture money down the line? We see venture money in before us. We see venture money coming in after us. We see it coming in at the same time as us. I mean, at the end of the day, I think the short answer is just no. At the end of the day, VCs are accustomed to creative financing and respect that entrepreneurs need to find a way to grow their businesses. So I've not run into anything in the last couple of years where it was like, well, our VCs don't want us to take it. I have seen, as Alan said, a couple of times where investors said, well, we would just rather write this check than have you raise it from somebody else under some other format. But that isn't necessarily a bad thing for you when your investors get excited.
I want to touch on something I think we all kind of talked about, you all kind of talked about within your slides, but this is a good question. So, any particular industries that you like or dislike? I think we heard SaaS and tech-enabled services a number of times from each of you. Obviously, there's reasons that those are good fits. But other type of industries or businesses or business models that work. And the second part here, if so, would RBF lenders provide funding for the business if the business is willing to transform to a more recurring based model?
So I'm looking at that question, and I think is it only for tech or SaaS businesses? No, definitely not. I think RBF works for any number of businesses that have a good and solid fundamentals. For companies with PO-based revenue, I mean, we've provided funding to companies that are more like PO-based revenue companies. I suspect everybody on the panel has. It would be awesome if everybody was super recurring and subscription based. It would be easy for us because it would be easy to analyze and easy to make decisions. But that's just not how it works, right? I mean, entrepreneurs are building companies. It's super complicated to do that. And so sometimes revenue streams are really complicated, and the revenue stream has to match the market that the entrepreneur is in. So the way we view it is show us the revenue and let us figure out how we can do it. But it doesn't have to be strictly SaaS or strictly, tech. We're comfortable with POs.
So I would add that to the question Casey asked about some profiles that we don't. Our practice is we don't generally fund D2C or CPG related companies. It's more of the SaaS retainer repeating cash flows because it's that predictability. The thing for the model that we follow, because we don't take any collateral, your personal collateral. So, it really is on the strength of predictability of those cash flows that are really key. And so that's one of the reasons why we look for those companies that have the B2B predictable revenue to be able to, do that type of assessment as far as the amount of funding that we can provide.
We have about 2 minutes. I'm going to throw out one last question in case we can cover it quickly. Maybe BJ, this might be addressed to you. Can you describe revenue-based financing with the equity component?
Revenue-based financing with the equity component. It's just a separately attached warrant. So a warrant, for those that don't know what it is, it's a little bit like a stock option. It's basically gives you the right to buy shares for a period of time in the future, usually 10 years, at a set price. The price is set today. So if the company goes up in value and you have the right to buy shares at a lower price, like today, whenever the company has an exit event, usually, then you exercise the warrant, you get some of that upside. It's basically just like a stock option. So it just means having an equity position. It's not a direct ownership position of shares. It's just a warrant that gives you a right to buy shares, usually when they exit. And it's usually a relatively small amount. We're talking about, 0.5% to 2% of the equity of a business for giving them millions of dollars. So it is a very, very, very small fraction of what an equity investor would get. Generally speaking, what we'll often do is, not always, but sometimes we'll offer companies a sort of with warrant and without warrant option and let them choose. Sometimes entrepreneurs are very focused on the cash and the cash flows. And obviously, if we can delay some of our return to the point where they have an equity exit, then we can offer them better terms in terms of the cash. Shorter term, other entrepreneurs, they want to keep that equity completely for their own benefit when they get to an exit event, and they don't want to have a warrant. And so oftentimes we're happy to just provide a pure RBF financing as well with no equity upside. So in general, it's a relatively small part of the deal. And that's why I think a lot of RBF providers don't worry about getting warrants. I think when you're doing larger check sizes like we are at the Spikes Fund, then you can spend the time on it. Like I said earlier, when I was at Lighter Capital, we didn't do warrants on deals. It would just cause too much friction when you're trying to do 100+ deals a year.
Thank you so much. We're going to turn it over to Kim.
Well, with that, I'd like to thank all of our panelists and sharing their expertise and insights. We have just so much superpower on this panel and have gone through probably, when you think about all of the hundreds of deals that the respective group here, it's collectively is probably well over 1,000 deals and expertise to go along with that. I also want to thank my esteemed colleagues, Randy Lipton and Casey Estrada, and Tracy Fuka for helping us with putting this together. It's definitely a labor of love. But again, I want to thank our panelists, Keith Harrington, Alan from Rebuck Capital, and BJ Lackman from IBI Spikes Fund. And I want to thank you, our audience, for taking the time to increase your knowledge and awareness of this amazing platform of alternative capital and revenue-based financing to grow your business. I hope you found this an enlightful discussion, and we look forward to connecting with you again soon. Please visit foundersfirstcapitalpartners.com to hear about our latest upcoming webinars. And again, good evening, and enjoy the rest of your evening.
Thank you, everyone.
Thanks, everybody.
Thanks, everyone.
Take care.